Hey everybody, welcome to SumZero. Today we've got a really interesting uh, set of conversations here with Strivepoint Capital. Um, this is a fund that was launched by three ex-McKinsey guys, Vishan Patel, Sambodhi Sarkar, and Akshay Rao. So we're going to be talking to them about three different stocks. We've got a lot to jam in. So with that, Vishan, do you want to kick it off on your end and just give a quick intro on sort of the philosophical um, bent you have on investing at Strivepoint?
Yeah. Actually, I'm gonna let Akshay kick it off for us.
Perfect. Thanks so much,
Actually, go for it.
Yeah.
Roshan. And Divya, thank you so much for setting this up and really looking forward to talk to you and sharing, some of our ideas with the listeners who've just tuned in. So as Vishal mentioned, it's three of us. I'm Akshay, a co-founder at Stripepoint, along with two of my other co-founders, Vishan and Sambodhi here. All three of us essentially, met during our time at McKinsey a couple of years ago. We spent, close to half a decade at the firm, specializing in the private equity practice. And that's really where we built a lot of what we would call our operator mindset or operator playbook, advising both private equity firms and Fortune 500 clients on how to think about investing in new businesses, how to grow and manage their own portfolio companies or businesses, and really building a blueprint of what would eventually become part of what we do at Stripepoint. We took that kind of operator playbook and combined it with Sambodhi's own prior professional background as a buy-side investor back in India, and created our own, what we believe, our own unique philosophy of how we invest in companies. And then sort of beyond that, Stripepoint Capital is a US-based hedge fund. We're a long biased fund that essentially invests along two strategies. So strategy one is our US strategy, where we invest in highly promising small and mid cap companies, hoping to outperform both the S&P 500 as well as the Russell 2000. Really a vehicle for diversification for our investors. And then strategy two is our India strategy, which is all about exploiting what we believe is the long-term growth potential of the country and the businesses that really benefit by operating within that region of the world. So that's in a sense of what we are as a fund, but our investment philosophy is really about four things. So number one is earnings growth and growth potential. Number two is looking at companies that we believe are trading at affordable prices. Number three is sort of what we would describe as the asymmetric upside or the asymmetric bet in the investment, which you'll see in some of our pitches that we'll talk about today. And number four is a clear value realization timeline. So how does this come together for us? Essentially, we are looking for companies that are run by deeply incentivized operating teams, that have the potential to grow their earnings at 20 to 25% on an annualized basis. They're trading, relatively speaking, at affordable multiples, and we plan to kind of realize those annual growth potential over a 3 to 5 year holding period. So we're not like super long term, but we are longish in that sense of
Well,
the
it's
word.
it's very long term by today's standards, where people are day trading left and right. No, that's really helpful, and I think what is affordable we can get into. That's always the where the rubber meets the road. So let's try. I mean, we have three stocks. Let's try to cover them each, in sort of call it 5 to 10 minute burst, if you will. I think it should give enough time. Should we start with Lyft? Should we get going on that to start with?
Let's do
Yep.
that.
Let's do it. Great. Vishan, I think that was your name. Obviously a name everyone knows. I don't know that much about Lyft from a valuation standpoint, and I think a lot of people tend to lean towards like, the scale player in the space as the go-to target, which is why most people, if they want to invest in rideshare, they probably go with Uber. But, would love to hear the thesis on Lyft.
Yeah, definitely. So Lyft is a name that we had been kind of covering since we launched our fund and recently initiated position post our last earnings print. So I'll kind of give a bit of color on the business from a higher level, and then dive deep into the different prongs of our thesis. So first, Lyft was kind of a turnaround story before, like, they weren't doing that well. They were overshadowed by Uber. And then they hired a CEO, David Reiser, who came from Amazon and was one of Bezos's right-hand mans. And he has done a fantastic job of turning this company around into, focusing on execution and really becoming a compounder. So the thesis lies across, four aspects. The first is mix and media. So their partnership channels are a really important piece of their growth lever. And so they had a partnership last year with Delta, and they lost it to Uber. And the market kind of reacted negatively. It was going to be gross booking headwinds, and they kind of took that and turned it around to fostering new partnerships with new hotel groups, credit cards, and also with United. And the partnership piece is really important because it drives incremental margin. Rides that are linked with partnerships have higher margin because these riders are choosing more expensive rides. And you can see the mix of their total rides that are linked to partnerships is increasing. And that feeds into one of their other strategies, which is their Lyft media strategy, which is launching advertising within the app to drive further incremental margin. And in their investor day in 2024, they signaled around $400 million in revenue run rate from their Lyft media platform. Today, they have around 100 million. So that's going to be a key piece to helping them achieve their targets they had set out, which is doubling their EBITDA margins from 2024 to 2027. The second piece is their supply piece of the business. So they track very closely the driver preference. So we're seeing that the driver preference is shifting more towards Lyft from Uber, which tightens expected time of arrivals for their riders, also reduces cancellation, and helps
Is
them
that
reduce their
because they
promo spend.
the Lyft drivers get paid more than they do on Uber? Why would they be preferring one over the other?
Yeah, that's a good question. So it has to do with the specific feature stack. So they have focused, like, David has taken this playbook from Amazon, which is customer obsession, right? And at Lyft, the customers are the drivers and also the riders, and they're focusing on making it a better customer experience holistically. And they've done that by launching a few features like price lock, guaranteed airport pickups, Lyft Silver, which targets elderly. So by creating a platform in which the drivers are getting lesser cancellations, getting matched with riders quicker, it helps them get more visibility into their earnings potential, and then also creates a better experience for the riders themselves. And this kind of funnel and cycle keeps expanding, in the network that they have, creating a better overall experience and capturing more people into the platform. So they're really like trying to build a supply moat on that side by also pushing better product features, leading to higher customer stickiness.
When did the new CEO get hired?
He came early last year. Yeah,
And do you have any sense of what his comp package looks like? Do
I
you know
do
how much
not.
exposure he has? I'd be
I do
curious how
not.
much stock he has. But yeah, you're I don't want to interrupt, so you can keep going.
Yeah. So then the next piece, which is really interesting, is they recently made an acquisition, which expanded them to Europe. So they acquired this company called FreeNow, which does it's like a taxi marketplace in 9 countries. And before it was a pure play North America focus, and now you're seeing them kind of branch out into new geographies. So the FreeNow expansion adds 9 countries and doubles their TAM. So it just really creates additional growth levers for them to execute, their partner data, Lyft Media kind of execution platform on. And more importantly, they also have partnered with Baidu to do a kind of test market AV launch. And they are using the UK and Germany to launch their Baidu partnerships first as a test market. So what they're doing is they're acquiring a fleet of these Baidu AVs and launching them in Germany and the UK targeted in 2026. And then the last piece, which I'm sure everyone is interested on hearing about, is the kind of whole autonomous vehicle narrative. So, the autonomous vehicle story has really been a multiple overhang on Lyft. And, to me, there's a few things that are clear is that it's not really a 2 to 3 year earnings risk for Lyft. Like, I think Lyft is going to be focused on their kind of compounding business, driving their incremental EBITDA margins and growing the business, through some of the levers that I mentioned earlier. But more importantly, the mass deployment of autonomous vehicles is actually beneficiary for Lyft. It increases the total TAM and the amount of ride volume that's gonna kind of occur in the system. And these platforms like Lyft are central to helping monetize AV fleets, right? To reach their expensive vehicles, to reach the break-even unit economics, you need a lot of ride volume. And to be able to achieve that, you have to push the AVs onto the platform themselves. So, I think
Well,
Lyft.
they own the customer. So in theory, the AV companies are going to have to, or probably going to want to leverage Lyft's installed base to get people in their cars.
Exactly.
It's probably, I
Exactly.
can see that being the path.
And there's another
But
piece of it too, right? Which is the autonomous vehicle management, right? You have a whole fleet, like you have to charge them, you have to clean them, you have to maintain them. And they have, their flex drive portion of their business, which is currently more geared towards the operational side of rental cars. But that is going to be a piece of the story when,
so
AV deployments come, when they transition
is
on that.
Lyft a fleet operator? I mean, is that fleet operation is part of their current business? It sounds like.
It's a small portion of their business, yes.
Is it something
So
they plan on growing? Is that something they want to have more of?
So they haven't given much guidance on it. They do disclose the revenue separately. It's a really small portion of their business. I think like 2 or 3% of revenue. But
Mhm.
it's become clear to me that like the management team has this kind of vision on where they sit in the value chain with AVs, and they want to do the right things to position themselves to capture, wherever the value ends up falling, whether it's like, helping monetize AV fleets or doing the fleet operations side of things. And I think they're doing a really great job of positioning themselves. Also, by turning this management team has turned around the business as well, and really helped them gain some share compared to Uber, and they don't have to discount as much anymore. You can see the customer kind of mix shifting towards Lyft. So I think all of the right signs are pointing in the right direction.
So let's talk about valuation a little bit. Yeah, I mean, do you just look at it on an earnings basis, or how you, or I don't know, you mentioned EBITDA earlier. What
Yeah.
multiple are they at now? What's the current growth rate look like? If you can just kind of paint that
Yeah,
picture.
what they've guided to is a 4% EBITDA margin on gross bookings by the end of 2027. And today they're sitting at the low threes. Before they were in the high twos. So they're doubling their EBITDA margin over the next 3 years. So what we modeled this one over a 3-year hold period towards the end of 2027, and we're seeing a 25 to 30% EBITDA CAGR over that period. And today, the company trades at around 7 times the 2027 expected EBITDA. So, when you kind of balance that relative to the EBITDA growth that Lyft is going to deliver, the valuation side of things is looking very attractive. I think on the hedge fund side of things, it's become a popular trade to like, long Uber, short Lyft. So there's a lot of short interest. And you can see too, like the reason we initiated position after the last earnings was they missed revenue by like 1% and the stock traded down 10%. Like people are not taking in the longer term growth compounding story here. And we think that these shorter term price dislocations offer a great time to build a position and hold Lyft for the long run.
Couple of things to
What's
add
Yeah,
very
go
quickly.
for it.
The long Uber short Lyft narrative was mostly made popular because like Lyft was consistently losing market share to Uber. That has changed and flipped around under the new CEO, which is what made us more comfortable owning Lyft going into this earnings. And the second thing is, we talked about the valuation multiples, like on forward, like 1 year forward expectations, it's at a 10 EV EBITDA. So which is like pretty low for a company which is expected to double EBITDA at least over the next couple of years.
What is it on an earnings multiple basis?
So 1 year forward PE is right now at 13.4.
Okay, and then what is Uber at? Just as a point of comparison.
Just 1 second, I'm just pulling up Uber. So point of comparison. Second. Yeah, Uber is at 20 EV EBITDA 1 year forward and at 29 PE.
Yeah, I mean, so it's like twice or more.
Yeah.
Yeah, and
There's
I
also
guess
the difference, like, like Lyft is mostly a ride hailing business. Uber has both ride hailing plus your delivery business. Delivery business has better modes. So
expected to have a slightly higher multiple, but even after adjusting for that, it is a significant discount.
And the 4% EBITDA margin target, it sounds like they're looking to get to a 4% EBITDA margin. I mean,
That's on gross bookings too.
On gross bookings. So what could that be 10%? I mean, I guess what are their costs? Is it just they just spend like crazy on tech? I mean, this is like an asset light business. I would think so.
So
You would
so
expect
one of
margins to
the so one of the large cost items is insurance. They have to pay the insurance costs for their drivers. So that's been a large line item for them, and they have focused a lot on reducing that cost and figuring out how they can minimize the cost there. The other thing too is like being like smart and figuring out, hey, what are incremental EBITDA driver opportunities, and like that's why we really love the Lyft media side of things, because launching an advertising business inside of Lyft is really valuable. Like if you think about like the wealth of data that they can sit on their customers, like you're going from location A to location B, maybe you're going to a shopping center, they can do targeted advertising. Like there is good indication that the ROAS for the advertisers are higher within the Lyft platform, given the data that they're able to take from the riders and feed that into specific targeted advertising. There was an interesting thing they had launched last year, which was a partnership with Sephora, where Sephora sponsored essentially free rides for riders to Sephora stores. And, then it's like kind of a win-win situation for both parties, where Sephora is, spending some money, but getting high intent customers already in the door. So like, I think there's a lot more opportunity on the advertising side of things for them to incrementally grow their margins.
And it's pure profits flowing into, the bottom line.
100%. Vishaan, this is great. I know we're tight on timer, so let's go to Remitly Global. Sambodi, I think that's your name, right? Yeah, would love to hear about that one.
Awesome.
Another small cap.
Yeah, Remitly is around like 3.5 billion right now. So the Remitly, for those who do not know, Remitly is a digital first remittance platform that facilitates like mostly small and mid-size international transactions. And they are consistently, competing with and gaining share from the legacy players like Western Union. So the three main reasons why we really like Remitly at this point of time is, firstly, it meets most of the criterias that Akshay had laid out. The things that we love in a company: strong founder-led, mission-driven company, solving real customer pain points, and strong network effects. So this is the same playbook that I had played previously in Robinhood and Coinbase within the fintech space, which obviously has played very well over the last couple of years. So similar setup in Remitly. Their CEO Matt Oppenheimer has been running this since 2011. He's the one who founded the company after experiencing real pain points with digital remittances while he was posted in Africa. The second thing is, this is operating in a very highly resilient market. So if you think about the Remitly customer, these are people who are mostly immigrants living and working in the US, earning, decently good salaries. And they have parents and relatives back home in India, Mexico, Philippines, etc. These are the largest three corridors that Remitly has. And their family really depends on their incomes and the remittances for survival. So it's not that someone can randomly decide that I will not send the $1,000 this month because their parents will be in a bad financial situation because of that. So it's a highly resilient market, and they were primarily just focused on one product, which is the peer-to-peer remittance transfers before. But now on this earnings call, they expanded their TAM and they're moving to a multi-product company. They introduced two different products. One is Remitly Business, which is like doing the similar thing, but for small and mid-sized businesses rather than just individuals. And the second thing is Remitly One, which is like a wallet where people can actually store money in different currencies and earn yield like you would get in a Coinbase wallet or in a Robinhood Gold wallet. So that product will also help them earn quote unquote float income, which is again like similar to Lyft Media, is a direct pass through profits to your bottom line. So because of the introductions to these, because of the two recent product introductions, we think the revenue can do a step jump going forward. And the third thing is,
what's the revenue now?
So it's around just crossed $1 billion. That this year we are expected to be around 1.5 billion.
And what's their fee on remittances?
So their gross take rate, what they talk about, is around 2.2% right now. For comparison, for Western unions, it hovers around the 4 to 5% range.
So is that how they've grown to $1 billion in revenues? They just kind of, by offering a lower fee, they have attracted more customers, or is there's something about the interface or the countries you can send money to that gives them an edge over? Like, I'm trying to understand their competitive position a little bit.
Yeah, no, great question. So, I'd say like three things broadly. The first and the biggest thing is about the shift in the entire remittance markets from cash-based remittances to digital remittances. So Western Union really specialized in the cash-based network. So someone in the US actually going to a Western Union storefront and giving like them in cash, and then someone in Mexico, their recipient, getting cash out from a Western Union store. So that was the really big model for Western Union, sending cash across borders. Remittance, like Remitly and other TransferWise and a couple of others, focuses mostly on the digital remittance space. So someone here is earning money, they have a bank account, they are sending money, transferring money from their bank account to a bank account in India. So that channel has really gained momentum over the last 10 years when Remitly has been in action. And the share of that channel has grown consistently, and Remitly has been a natural beneficiary of that share growth.
Those customers would rather do that than just send a wire using the Fed wire system? Like why do they?
So that's a great, there's a natural first question which I had when we were first looking into it. So if you think about it, the usual customer here is sending $300, $500 a month. So if you are including a wire transfer fees, for international wire transfer goes to around like a $50 fees, that becomes like an increasingly prohibited. So that's like 10% of what you would totally want to send. So 10% fees, versus Western Union will charge you a 4 to 5% fees. Remitly will charge you a 2 to 3% fees.
And then how do you think about stable coins in this context? Because obviously that's like almost much low. I would imagine lower than 2% or 2.2%, which you mentioned.
Yeah.
So
that's a great question. And that's where I was going to the third point of the thesis. The stock is actually down 20% year to date, like because of two broader headwinds. The first was like a proposed remittance tax, which was in the one big beautiful bill, a 5% remittance tax, which now we had a pretty clear thesis. We understood how it would not be actually a tax, but actually be an income tax credit, and would hurt the customers of Western Union, but not hurt the Remitly customers because they are doing transfers through a digital transfer. They would get it an income tax credit when they were filing the income tax at the end of the year. Those things have played out, but the stock has not recovered. The second is the stable coins. So stable coins, essentially, a lot of the questions on the SumZero platform about Remitly has been on stable coins. So if you think about the entire transaction flow, there are three parts. Like first is the pay-in, when a customer is taking money they are receiving from their salary in a USD bank account and transferring that to a Remitly wallet. The second is Remitly is transferring that money internationally. So taking that money and sending it to in India, Mexico, etc. And the third is then that partner, their partner bank or other financial institution or wallet is giving the recipient, transferring the recipient that money. That is called payout. So what stablecoin does is helps you in the middle layer, which is actually transferring that money internationally. They solve they bring down the transaction cost there. What they have not been able to do thus far is reduce the cost of actually when someone is paying in, so someone has to, instead of taking that money from their bank account and sending it to Remitly, that the customer has to do the same thing. Take the money that they're earning in USD in a bank account and transfer to a stable coin. There is no fees associated with it, so there's no charge. The last step, like someone actually transferring the partner network actually transferring that money to the recipient, that is, in that case, if you're transferring using stable coins, you actually have to go through the fiat currency transfer, where you are increasing the cost. So there is one. So essentially, if you look at the three parts of the value chain, one, the first part, the pay-in, it's a neutral, no impact. Second, stable coins actually bring down the transaction fees, and third, stable coins will increase the total the rate which is there. So net, what is happening is that we have a long conversation with the Remitly team on this one. Their viewpoint is that stable coins will bring down the total transaction cost and therefore bring down the take rate. But what is going to happen is that because the overall transaction cost is also coming down, they will essentially be able to pass on that transaction cost to the customer, and therefore net equal what they would be if they did not have
So
a stable coin
it
transaction.
sounds like if I send money to my cousin in India,
Yeah.
If I send them in, so like I have USD here, then I go buy a stable coin. So let's say I buy USDC, then I send USDC for free to India. But then when they want to convert that back to INR, it's their bank that's going to charge a fee there.
Yes.
And you're saying that that fee would be potentially lower with the introduction of stable coins, but somehow Remitly would maintain its margin, if you will, or I'm still a little confused on.
Yeah, just to clarify there. So what I'm saying is that the transfer of money from USD to INR is where the Remitly has to pay a cost on that. That is the cost which stablecoins save, right? And Remitly will also use stable coins. They have also started using stable coins. They have a partnership with Circle right now, where customers can also put stable coins through the Circle, like USDC, on the platform, and they can facilitate a transfer directly from on a stable coin from here to India. What I'm saying is that the last mile, their bank, their bank has now received money in like USD or in stable coins. Right now, transferring that money from USD to INR is cheaper than transferring that from USDC to INR.
Interesting. So you just don't see the stablecoin as a threat here, at least
No,
in
so
the near
stable
term.
coins, what they will definitely do is bring down the overall take rates. That is pretty understandable, and therefore there will be sort of a revenue hit. But what really matters for this industry is the gross profit, because stable coins will also bring down the transaction cost for a Remitly. And therefore, even though the revenue will be impacted, we do not anticipate a similar gross profit impact.
And when you look at the competing, like the other alternatives out there, I mean, there are a lot of remittance businesses. I mean, you can PayPal people, I don't know how Venmo works with international cross-border stuff, but I guess what is the biggest competitive threat to them that you can think of?
Yeah. So actually, I think the
Doesn't
biggest
sound like it's Western Union, but
Yeah.
I mean, I'm curious what else.
the biggest competitive threat will be here if someone like a Coinbase, which has deep integrations with Circle and international users, etc. If someone like Coinbase is able to achieve this entire transaction flow at a much lower cost, and let's say like Remitly has around a 65% gross margin, so with a 22.2% take rate, their transaction cost runs to around like 70-80 bips. If Coinbase is able to use Circle and USDC and bring down the transaction cost to, let's say, 20-30 bips, and therefore go ahead and launch a digital remittance platform where they are able to transfer international money with a 0.5 or a 1% take rate. That is the biggest competitive threat that Remitly faces. And, admittedly, that is why the stocks have been down. Like nobody has come out with this product yet, but similar to Lyft, like is AV a potential threat 5 years down the line? Yes. Is it a threat right now? No, because Coinbase has not come out with the product yet, but that is the biggest competitive threat that Remitly faces in the long term.
And then from a valuation standpoint, how does this trade right now?
Yeah, so it's a similar setup to Lyft. This management is expecting revenues to grow at around 25%. We are slightly conservative. We are thinking that revenues can grow at around 20%, but there is strong EBITDA margin expansion happening. So we are projecting, Street is projecting around a 50% EBITDA CAGR over the next 3 years. We are projecting somewhere between a 35 to 40% CAGR. With that, the current 1 year forward EV EBITDA is 13x. We are saying 15 to 20x is definitely reasonable for this kind of business. So we are seeing 25 to 30% IRR over the next 2 to 3 years for Remitly.
Super interesting. I mean, you're kind of at the nexus of a lot of technology change. Yeah, super interesting. Let's move on to Sarepta, and then of course we can revisit both Lyft and Remitly later if folks want. But Akshay, tell us about Sarepta Therapeutics. Would love to hear the thesis there.
And I know biotech is always there's a lot of memes about biotech investing out there. So
well now it's I think you got Vivek Ramaswamy kind of pushing biotech, the face of biotech now. So I don't know if that's good or bad, but well, I will say for value investors, biotech is a very difficult industry to get their head around. So it's very interesting that you guys have that exposure. And the valuation on biotech is it's a whole more hypothetical exercise. So we'd love to hear it. How you kind of underwrote the whole name.
That's a great segue. In the biotech investing that I've seen, you typically end up in two sorts of puzzles, investment puzzles. So there's one puzzle which is betting on a risk event, typically a clinical trial. You got a pre-revenue biotech, and it's going from phase 2 to phase 3, and investors are betting on the success or failure of that trial, taking one side of that edge. So that's one whole class of bets. Sarepta falls in the second class, which is really about assets and prices. What is the quantifiable value of the assets and how is it currently priced in the market? And a little bit of background for listeners who are not familiar with Sarepta. So Sarepta is a gene therapy company that focuses on rare diseases. Specifically, it's been focused on a rare disease called muscular dystrophy. And a form of muscular dystrophy, which it's got a lot of media coverage on, is Duchenne muscular dystrophy, or DMD, let's just call it. Now, this is basically where, there are some genetic defects that you're born with that does not allow your muscles to grow. Essentially, a protein is missing, your muscles don't grow. It affects about, 1 in every, 3,500 to 5,000 boys because it's on the X chromosome. And it's got a really bad mortality rate. By their late teens, they can't walk because their muscles haven't developed in their legs. And by the late 20s to early 30s, the survival rate without, even with old school treatment is, with steroids, etc., is 30%. So pretty high risk disorder. And that's what Sarepta decided to focus on. A couple of reasons why we like the company specifically as an investment. So first is, as I mentioned, it's not a pre-revenue biotech, so it takes a lot of the pipeline related risks out of the picture. This is a company that over 2020 to 24 has been growing revenues at in the mid 35% range, and more recently even clocked in 50% in the last year with the launch of one of its big blockbuster products. So that was really promising. Second is it is the asymmetric of asymmetric bets. A company that was
let's hear it. I'd love to hear that. Yeah.
Circa 2024, this was a biotech darling. You look at some of the folks covering this company, it's like, oh, what amazing innovation engine. Stock is trading in the $120s, $130 per share, even up to Jan earlier this year. and then suddenly it's just fallen out of favor, has corrected quite a bit, has lost about close to 85% of its equity value in 2025. Now that didn't happen by chance. There were a set of negative catalysts, specifically certain patient deaths, that caused this massive correction. But where it stands today in terms of its equity price, that's about, it's been teetering around $18 to $20 per share. When you look at the value of its assets, it's trading at a deep discount to what the assets are worth. And third and most importantly, we believe a lot of the issues that caused this massive correction have already played out, and it's kind of been dinged more than it deserved, so to speak. And it creates a really good kind of downside risk protection for as we started looking at it as an investment. So that would be like the broad three reasons. And I think the natural question is, okay, this is about assets and prices. What are its assets? So Sarepta basically has three sets of assets. It's got its legacy treatment business. We call it the PMO franchise. It's been running that business for a couple of years to treat DMD patients. Then in 2023, it came out with its blockbuster treatment called Elevidys. It's a one and done gene therapy. You get one infusion, and then it's supposed to help you build your muscles over the years, and it's kind of, it's fixed the genetic defect. That's its second asset, and third is, its pipeline. Just to put a little bit of numbers, the PMO, the legacy business, clocked in about $967 million, so close to $1 billion in revenue in 2024. And Elevidys grew from like 250 million in 23 to about 821 million in 2024. So this is not a small, it's still a small biotech, but not super small. But when you start thinking about what could be a fair way to value the assets, it is essentially trading at a 2.5x EV to peak sales multiple of just its legacy business. 800-900 million is its legacy business, applied 2.5, and that's its current enterprise value, about 2.5 billion. And so you got this massive asset that could generate anywhere between 500 million to 800 million on the conservative side in terms of annualized revenue. That's just not there in the equity price today. So that's really what makes it super attractive to us.
I mean, I was just looking at the stock price graph. It's fallen 87% in a year, which is incredible. And the thing is, I guess if you're a value investor, like a stock price fall of almost 90% can get exciting, but how do you know you're not just catching a falling knife? I mean,
No, I think that's an excellent question, and it comes to what's the story? What actually transpired that caused this drop? So as I mentioned earlier, in DMD, you've got patients who this treatment is typically given to kids under the age of 3 years old, so they're pretty much infants. And the risk of something that's modifying your gene is almost similar to organ transplants. When you typically hear about organ transplantation, you talk about body rejecting the organ, liver issues, etc. And that's a known problem with this specific gene therapy. Last year, they were only focused on what they call the patients who can walk, or ambulatory patients, they call it. And so it was a relatively safe segment that they were currently approved to kind of treat. Then, in Q3, Q4, they got the FDA approval under, some would say under duress, there's a whole political event that happened around, Peter Marks passing and giving them approval, and I won't go there. But, they were approved for treating non-ambulatory patients. That itself, you should think of like, okay, now they're allowed to treat a treatment that's high risk and give it to the most highest risk of patients. And that's exactly what happened in March this year. Acute liver failure and elevated liver damage is an issue. So, they started treating non-ambulatory patients where the disease had progressed, the equivalent of like stage 3 cancer, you can think of it that way. And, there is a risk of mortality. So in March, they announced that there was a patient death. That's when the stock was corrected to the 50s. Then a couple weeks or a month later, there was a second death. Stock corrects back down to the 20s. The FDA starts getting worried and say that this is really bad optics, and we need to just stop. Doesn't matter whether the patients could walk or don't walk. We need to take this drug off the market. And that's when the stock found its all-time bottom at $10 per share. A couple of almost a month ago. Now, all of that noise is, kind of dissipated. And so, question is, where does this really stand today? So in terms of the non-ambulatory patients, the FDA has said like, okay, you need to run, a 24-week trial, prove that you can kind of limit all these sort of liver damage issues through some immunosuppressants, and then maybe we'll consider you getting back. But they are still allowed to commercially treat, ambulatory patients, which was always true, even a year or 2 years ago. So nothing has happened. If you think about it, the company is in exactly the same stage as it was like mid last year in terms of what it
So,
is.
yeah, I mean, in terms of the science and like just the actual treatment, does anyone else do this? So what, like, are they the clear leader in the treatment of DMD or not? I'm just,
They're pretty much
what's
the leader, and they have market exclusivity. You can almost think of this therapy like similar to, other technologies like CRISPR and, creation of the COVID-19 vaccine and mRNA treatments, right? So they're essentially creating this viral vector that is going in and modifying the genome of the patient through a specialized infusion. They have essentially the biologics exclusivity that they got in 2023, and they have exclusivity up till 2035 on that. And so they're fairly well protected on their major Elevidys blockbuster drug. On the PMOs, they're literally trying to get patients off the PMO business and onto Elevidys. So it's kind of a little bit of cannibalization, but you can almost think of it as they are their own best competition at this stage. The thing about Sarepta, and also more broadly about why we like rare diseases, is that these markets and companies function as localized monopolies. The best analog I can give you is your local cable TV operator. No one really wants to compete with that guy because the total addressable market is too small for the large big pharmas to come in and play, and it's too hard for anyone without resources to enter. So you always find these as sort of small scale monopolies, or max one or two players in these spaces, and you get a lot of support from the FDA. So from that dynamic, we don't see a lot of risks in terms of a company kind of coming in and sort of genericizing it. There, to my knowledge, there hasn't been a generic gene therapy yet. So I think we're at least a decade away from that.
so, and then what's their next? I mean, what's in the pipeline as far as other treatments? I mean, is there any, like, can the existing treatment be applied to other diseases, or is this like a one-trick pony? Like, how do you think about diversifying that revenue stream over
That's a
time?
great question. So recently they, as they were going through these issues, they also launched like a whole bunch of cost-saving transformations. And one of the things they did is they rationalized their drug pipeline. So a couple of the products that they're focused on is something called the siRNA platform. And they licensed that platform from Arrowhead Pharmaceuticals, which is also a public company. And they're hoping to kind of treat other forms of muscular dystrophies. To my knowledge, there are like 50, 60 different genetic variants of muscular dystrophy, not just DMD. So they're hoping to continue kind of treating that disorder, but they're also hoping to enter into other places like Huntington's disease. So there's a lot of promise around, what they're doing in terms of, extending their revenue trajectory beyond just these two big franchises that are commercial today.
That's great, actually. Let's there are a lot of questions here on the chat. I want to start going through. We don't have to go through all of them, but we'll go through some of them. This one's actually on Remitly. So the question was, how do you handicap SoFi entering the space and claiming they're going to be the low cost leader? Somebody, this is for you.
Yeah, I just replied to that. I think that this is what I was talking about. Coinbase, taking the example of a company like Coinbase, SoFi is similar. SoFi had been trying to, they had a crypto product before they got banned, and they recently like launched this product. And I have massive respect for SoFi. I'm personally also a SoFi shareholder since like $6 per share. I think this is where Remitly will really can face competition, because there will be companies like SoFi where they can enter this market with much lower take rates given this thing. Upon our conversations with looking at market shares, etc., like any of the new competitors have not been able to take significant share away, and Western Union still, after all of this, is still a very big business. So we generally feel like, Remitly has a 2 to 3% market share within the entire like remittance pie. Like new players coming in should be able to grow that pie or take share away from players, including Remitly. I don't think like it will be unfair for me to say that SoFi cannot take share for Remitly, but I think that the pie is large enough for Remitly to continue growing, even if there are new entrants like Coinbase or SoFi.
Are they an acquisition target for anyone?
Yeah, they're fairly small. Like if a Coinbase, if a Coinbase or a Robinhood, like for example, wants to go and like enter into the digital remittance space where they have not played before, they can definitely be a good acquisition target, like 3.5 billion market cap, with a strong balance sheet and growth engine. Like I don't see why they cannot be an acquisition target.
Is there anything in terms of their tech that's worth calling out? I mean, if they were acquired, I mean, people would be buying them for like the customer base, the brand, whatever. But is there something to the way they do the transaction that
Yeah.
maybe differentiates their process versus what a SoFi might do or what another player might do?
Yeah. So I think the biggest challenge or barrier to entry, which would make the good acquisition targets, is actually solving the last mile payment network to the recipients. You need to have very, very strong partner integrations in the third country where your network is being set up. So they would have partnerships with all leading Indian banks, with things like UPI in India, which has become the main money transfer network. So to build those networks takes a lot of time, regulatory approvals, compliance checks,
Yeah.
etc. That will essentially be the big thing why someone can acquire them.
Got it. Very interesting. Vishan, on the subject of Lyft and autonomy, it sounds like you guys have like a 3 to 5 year hold period or trying to target hold period. Is it fair to say that you think the autonomy risk is kind of beyond that period, like that's more 5 years out and beyond, or how do you think about when autonomous vehicles potentially become a problem for Lyft? Or do you think that Lyft somehow benefits from that anyway, because, even if costs come down on rides, let's say per mile, the driver cost saving is big enough where maybe they just buy a fleet of autonomous vehicles and that becomes their approach to autonomy and they're able to kind of maintain their business that way. Yeah, I get a better sense of timeline around autonomy and how that might impact Lyft, and applies to Uber as well, obviously.
Yeah. So, I put a lot of thought into this, and I think what's most clear to me is that, autonomous vehicles increase the, TAM for their market. Like there'll be more rides that are pushed through their platform when AVs are deployed at scale. And that's the same
And
narrative.
why do you think that is? Is it because the cost will come down per ride?
Yes. Yeah. So I think you have to evaluate a few things. First, like the key metric is really cost per mile. But then the second is also the break even unit economics for a specific AV, right? So the big dark horse that people worry about is Tesla, right? Like, is Tesla actually going to be able to achieve full scale AV that's, regulated with a camera only stack? Because with the camera only stack, their cost per vehicle is much lower than their competitors. So that's the big question mark. I think that's the biggest risk here. I mean, there's some people who believe that they're going to be able to do that and they're going to be able to capture a significant share in the AV market. Then the counter narrative is like, okay, will Tesla be able to build a platform or a marketplace that rivals Uber or Lyft, or are people who own Teslas or who have fleets of Teslas going to be able to deploy their Teslas on a Uber or Lyft platform? So I think when you think about Lyft and Uber, like they really are a ride aggregator. And there will be a point in time where the cost per mile, based on how much a specific person, uses their car and travels, it may not make sense to even own a car at some point in time. Where if you can just, get a car from the marketplace and there's enough availability of demand and supply, that like your car just shows up and takes you somewhere you may not even need to own one, right? So, but that piece of it is further out of, a 3-year hold period, I'd say. I think the few key things to watch are, new AV launches, who Uber and Lyft are partnering with on the AV side of things, definitely watching regulations. A big piece of Lyft's Free Now acquisition in Europe, which they cited, was the regulatory relationships that came with Free Now. So, they believe that they have the right to win there because of the relationships that came in this acquisition, where like they'll be able to launch their Baidu partnership in Europe more quickly because of those relationships. So it'll be interesting to watch across, Tesla, Uber, and Lyft, any commentary on how AV deployment is going and that sort of thing.
What is the Baidu strategy exactly? Like, does Baidu have their own autonomous car, and then Lyft is
Yes,
just
correct. Yeah, so they haven't given much context to it, from the calls, but what we do know is that they are kind of viewing this as a test market, to where they're going to acquire a fleet of Baidu AVs, maybe 50, 100 cars. I don't know what the
is the
exact number is.
Baidu AV does that one have a LiDAR, or is it just a camera-based one like Tesla? You know what they look like?
I believe it's LiDAR. Let me check.
So it's more like a Waymo than a Tesla.
Yeah.
Yeah. I think Tesla is unique in their
In their
approach, that they are doing only camera based. And essentially, like when we thought about this a lot, is if Tesla is able to actually do it pretty well, then they can defeat everybody, because their cost will be so much lower than a Waymo or any other LiDAR based companies.
Yeah, there was an interesting. I read an interesting article recently about. It was like a journalist who compared Tesla to Waymo, or like the robo taxi versus the Waymo car, and it sounded like from that experience, that article at least, that the Tesla robo taxi was not actually as good at navigating uncertainty, and just wasn't able to sort of deal with um, the real world surprises that come with being on the road. And obviously, like Waymo has like a much longer sort of track record now of like live miles, being fully autonomous. And I do have friends who were like, I would never sit in a robo taxi, but I'm comfortable sitting in a Waymo. So it's a very interesting setup, because like Waymo seems to have a lead from a safety standpoint, but I think you're right. Like if Tesla can kind of get their systems working,
Yeah.
it is a much cheaper uh, approach, because I think that like those Waymo cars are like 150 grand, 200
Yeah.
grand.
Yeah,
It's not cheap.
exactly.
So if Lyft wanted to do that, to own like a fleet of cars, like that would certainly add up. But
Mhm.
I think we're in like a 3-year period where over the next, let's say, I think probably 3, like that, those costs come down too. Like there are cheaper and cheaper LiDARs, where you still get the safety, but you're not spending a fortune to build out each unit. Um,
But what's going to happen, Divya, is essentially like what Tesla is trying to do is to have the same technology in 2030K versus like, the current 150, 170K for Waymo. So even if that 150, 170K, let's say, comes down to 100, it'll still be significantly more expensive than a
more,
2030K.
There's one question here about SRPT financing. Will they dilute you? I don't know if Akshay has anything to say on that, but
I do. I think this might be referring to the recent like debt note restructuring that the company did. When it rains, it pours, right? Sarepta, they did announce like a restructuring. They had to kind of reduce headcount by 36%. They kind of canceled a lot of R&D programs. I think net that should bring about $400 million of SG&A savings, R&D and SG&A savings on an annualized basis. And then the final thing is they restructured some notes that they had COVID era notes that were priced at like 1.25%. They had to kind of renegotiate and get it up to 4.25%, which is not really bad given the current rate environment. And convert some shares. It was a little bit complicated deal. Net, it led to about a 6% dilution, and that's what we've kind of underwritten, about a 6% share dilution on an annualized basis. Even with that, when I tell you that, hey, take the most conservative EV to peak sales multiple, and you have $1 billion of enterprise value missing in the traded shares, I think there's a lot more upside versus the downside at current levels. Just I'm hunting for the $1 billion of enterprise value I can't find anywhere in the stock today.
That's a great way to end it. Guys, this has been super interesting. I know we jammed a lot in the last hour or so, but love hearing kind of off the radar views on, asymmetric situations that don't get a lot of coverage in mainstream media. So thanks for putting this together, and hopefully we can do this again sometime. And good luck to Strivepoint. Hopefully you guys crush it over the next coming years.
Absolutely.
Awesome.
Thank you
Thank
so
you so
much.
much, Divya.
Thanks
Take care,
everyone.
guys.
Bye.